Hi, everyone. Welcome. We're going to get started in just 1 minute. I am Andrew Flowers. Let me introduce myself. I'm excited to join you all here for the Appcast brief on September 6th. This is our September 2024 edition, where we're going to talk about the August U.S. employment report. I'm joined by my awesome colleague, Julius. Julius, you want to introduce yourself?
Yeah, hi there. Thanks, Andrew. I'm Julius. I'm a labor economist with Appcast, and I'm dialing in from London. And I write very often on our blog, mostly about the UK and Europe, but also about the US as well.
Yes, indeed. Well, we have some very interesting data points to discuss, some big news this morning. I'm going to get started, and I want to just encourage all of our attendees here to be active participants in the Q&A. Start firing away now. I mean, we're going to save at least 10 minutes in this half-hour Appcast brief for Q&A. And so if you have questions, start dropping them in now. But let's begin with the main news. I'm going to share my screen and walk you through some important numbers we got this morning. The August U.S. employment report. It matters a lot for markets, for the future of the job growth trend in the U.S., but it also could impact the coming election in November. So very important data points. Let's get started. Welcome to the Appcast brief. So I'm just going to jump right in, Julius. Julius and I are going to go back and forth and cover all the key data points from the August jobs report. So what's the headline of this report? Here's the one word I would give you. It's a strange word, tweener. Tweener. If you have, tweens, you may be thinking, what is he talking about? But tweener in the sense of this jobs report is kind of in between two states, and it leaves a lot of uncertainty, especially for the Federal Reserve. So at the top line, the U.S. economy added 142,000 net new jobs in August. So last month, 142. Now that's a rebound a bit from the numbers we saw in June and July, which were revised down. Julius is going to talk about that in a second. So 142, now that's nothing alarming, but it's also clearly a continuation of this slowing trend. So these blue columns you see here are the monthly net change in employment. So the most recent one to the right, that's August. But the lines that overlay this chart, those are the 3 and 6 month moving averages. And so you see how they're on a clear glide path downward, right? So this is something I want to acknowledge up front, which is that the U.S. labor market is clearly cooling. Hiring is clearly slowing. But it's a tweener jobs report. I use that word tweener because it's not clear, is this just moderation in job growth, a slowing in hiring? Because, well, a soft landing has been accomplished, meaning we've brought down inflation, we've cooled the economy, and with it, job growth comes down. Is that what's happening here? Or is this a sign of something more worrisome, an ominous sign that maybe the labor market is deteriorating, meaning hiring is slowing and maybe layoffs are looming on the horizon, and that we could be headed for a recession? In other words, which is it? Is it clear for the Federal Reserve to begin a gradual reduction in interest rates, maybe a 0.25 percentage point at a time? Or does the Fed need to take more drastic action to forestall a rise in layoffs? That's the question. So 142, that was the headline number in August. I want to just take a step back, though, and show you some data points that aren't directly related, or aren't purely related, rather, to this morning's jobs report. This is the big picture, right? The big picture is that the U.S. labor market is nearly at equilibrium. I think it's quite possible that history will look back on this month of numbers that we're talking about, August 2024, and say, yep, August 2024, that's when the lines here intersected, when the economy was in perfect equilibrium, where demand and supply equaled each other. And so what you're looking at here, the dark blue line here, is labor demand. That's total employment, which is part of what we're talking about this morning with the jobs report, but it's also adding vacancies or job openings. And you see how this dark blue line has been on a sharp upward pattern out of the pandemic, and then pretty high, and then on a slight downward decline in the last 12 months or so. It's at just under 169 million labor demand. The supply side here, the light blue line, this is just over 168 million. It's almost at the point of supply meeting demand. And that supply figure, that represents the U.S. labor force, which we also learned about in this morning's report. So the big picture here is 142,000 net new jobs in August, a clear slowing trend, and the labor market's at equilibrium, and the lines are about to cross. The question is, does this mean the top line is going to crater downward and we're headed for potential layoffs and the Fed needs to act quickly to reduce interest rates? Or rather, should the Fed just take comfort in this, that this is part of, a steady state we're reaching? We're kind of reaching a calm after the post-pandemic years, and that the Fed just needs to gradually reduce interest rates. So that's what I mean when I say this was a tweener jobs report. It was a tweener jobs report for the Fed. Now, one important note here are the revisions. Julius, tell us about those.
Yeah, definitely. So this is also something that is a little bit concerning, is that the numbers for the previous month have been revised downward, and actually by quite a bit. So this chart is just showing you the initial job numbers. That's the blue bar, and the dot is the revised data. And ever since the beginning of the year, actually, the revisions have all or mostly been negative. Okay, so for June, for the month of June, there was actually a downward revision of 60,000 jobs. And for July, there was a downward revision of about 25,000 jobs. So for those 2 months, there was an additional 86,000 jobs that were not created because the updated data just showed that the job growth was weaker in the previous month. So a little bit of a concern here as well. And so on top of everything else, we also found out in August that the BLS was revising the data from the period of March 2023 to April 2024. So what's happening there is that the BLS, obviously, every single month when they release the job report, they are not counting every single job in the US, right? That's a labor market of 160 million. That would be impossible. They sent out surveys to about 120,000 business, I believe, yes, covering some 630,000 work sites, and that's how they do it. They try to get a representative sample of businesses, and they ask how many jobs are being created. And so in August, we had a benchmark revision, and they revised the data between March 2023 and March 2024, roughly throughout this entire year. And they found out that actually, instead of roughly 2.9 million jobs being created during that period, there were only 2 million jobs being created during that period. I wrote a blog post about it. You can have a look at that. But that is obviously a substantial downward revision. It was one of the largest downward revisions over the last 10 years. Yeah.
So with that news, Julius, that we see a pattern here of downward revisions. I actually want to go back here and ask you, Julius, is this a total shocker? Because my sense is the BLS perhaps undercounts job growth on the upswing and overcounts job growth on the downswing. Meaning when hiring is slowing, when employment trends are declining, they being the BLS is maybe slow to catch this magnitude of downward revisions.
Yeah, that's true. So it wasn't a total surprise. Actually, a lot of economists from financial institutions and so on, they were expecting a downward revision for that period, and they estimated that it might be 400,000 or 500,000. I think Goldman Sachs even said it could be up to 1 million. So it wasn't a complete shocker, but it's still a pretty big number. And you are right that historically, when the economy is slowing, I don't want to say when we are heading toward a recession, but when the economy is slowing, usually what we see is that we will get a bunch of negative revisions. And so we are seeing that right now.
Got it. Now, with this context, folks, I want to pivot and talk not just about the employment gains and the revisions, which we just covered, but actually talk about the job seeker, the workers, and how the numbers from this morning's report shed light on the supply of job seekers. And so here, there's some good news where when we look at the prime age workforce or the working age people, that's those 25 to 54 years old, the share of them employed or looking for work, remains really high. It ticks down slightly from 84% to 83.9. But the point here is this prime age labor force participation rate remains quite high. You see, going back into the earlier parts of the 2000s, when we were at this level of labor force participation. So that remains high, and that's a good thing. But from this same data point, you generate the unemployment rate. And so the unemployment rate has rightfully drawn a lot of attention over the last year because it's been rising. Now, albeit it's been rising from a very low level, from like roughly 3.5%. It's been ticking up over the last year. So in August, we heard that, yes, we added 142,000 jobs and there were those downward revisions, but while that's bad news, the good news is the unemployment rate ticked down just slightly from 4.3 to 4.2%. But the trend here of it rising, even from a low level, and it's still pretty low because, 4.2 is still pretty good. It's the trend that has some folks concerned. And Julius on Recruitonomics has written about this, about the impact of some recession prediction rules that say, well, if the unemployment rate begins to rise upward, should we get worried that a recession's on the horizon? I want to pause here and say, this is an important point. The main driver of the unemployment rate rising is that new entrants to the labor force are less quick to find jobs. In other words, the job finding rate is slower. In other words, hiring is slowing. It's not that firing is rising. So you see this boost here in labor supply from the previous chart that I mentioned, right? There's new entrants into the labor force. That's all told a good thing. Those folks, as hiring has slowed, have had a harder time finding work. That's the main driver of this upward trend in the unemployment rate. It's not because we see a big uptick in layoffs. We don't. I want to repeat that. We don't see a big uptick in layoffs. So the unemployment rate ticked down slightly in August. That's a good thing. I do want to, however, call out this broader trend, which is that as the labor market weakens, there's a danger here because we lose progress on historically disadvantaged groups who benefit from a very strong job market. So here I'm showing the unemployment rate by race in the U.S. And you see here that historically African-American unemployment rates and Hispanic unemployment rates are higher than white unemployment rates. And with a strong job market in the post-COVID era over the last 3 years, all these unemployment rates were declining, and actually the compression, the gaps were beginning to narrow. As the labor market cools off, however, we want to just acknowledge this danger here of losing progress on that trend towards more equality. It's perhaps taking a step backward. Julius, as I covered both the overall job gains and then you went into the revisions, I covered the labor force statistics. I want to hand it over to you now to talk about all the industry trends.
Yeah, sure. Thanks, Andrew. Yeah, let's just have a look at kind of like the breakdown of job gains by industry. So you see there basically the 1 month change, how many jobs were added now in August, and like a 3-month moving average. So we have some 46,000 jobs being added in leisure and hospitality. We also have like some sizable gains in the construction industry, some 34,000 jobs being added there. Some 30,000 jobs being added in healthcare. So healthcare is interesting because it's been basically one of the sectors that has been adding a lot of jobs over the last 1 or 2 years. So a very strong sector. And we also have some job gains in financial activities and professional and business services. That's probably got good news because over the last 6 months, a lot of people have talked about this white collar recession that's become a little bit harder for people across white collar occupations to find a job. But we're seeing some small job gains there as well. Retail trade has been losing some 11,000 jobs, and manufacturing has been losing some 20,000 jobs this year. That's quite a bit, and that kind of like also reflects probably a trend that we are seeing in Europe as well. Germany at the moment is losing some jobs in manufacturing, and Europe in general. So we might have a little bit of a global downward trend in manufacturing happening right now, to be honest. Yeah, so if we look at the industries, you can see here healthcare has added some 30,000 jobs, as I said. That is down from the previous month. So if you look kind of like a longer moving average, we've seen in the beginning of the year, the healthcare has been adding consistently some 50, 60,000 jobs, and it slowed down a little bit. So that's been a very, very strong sector, but this month has definitely been slightly weaker now, actually. If we go to warehousing, it's kind of very stagnant. Warehousing has been adding a lot of jobs throughout 2020 and 2021. It then slowed down quite a bit throughout 2022 and 2023 with some job losses. And in recent months, it's been adding a few jobs again, but at a very slow pace, just a couple of thousand jobs each month, yeah, which is obviously not so much if you look at the size of the US labor market. Leisure and hospitality is quite steady. This month, it's been adding some 46,000 jobs, and that's actually quite a tick up from the longer 3-month moving average. So that's some good news. And yeah, some healthy gains there. And construction has been adding 30,000 jobs, and is actually also, if you look at the last 2 years, it's been quite steady. The 3-month moving average has been around 20,000, maybe a little bit more even. This is definitely a sector that has surprised me a lot, I would say.
Me too.
Because, yeah, and the reason is monetary policy. We've had 5% or more than 5% interest rates for more than a year. I would have expected that these high rates of interest would have affected construction and housing starts and the construction sector more than it actually did. So this very steady pace in construction is very good news and somewhat surprising for me. And now here we have manufacturing, and as I said, so we have some 24,000 jobs lost there. That's actually quite a negative number. Now, if you look at the last 1 or 2 years, it's been a little bit volatile, but the longer 3-month moving average has been basically around 0 at the beginning of the year. But now we've some more job losses there. So manufacturing not doing that well. And the tech sector, well, a few job losses there. In the beginning of the year, it was at 0 as well. There was obviously a lot of people talked about the tech session in 2023. There were some job losses then. But remember that the tech sector also performed very, very strongly in 2021 and 2022. So even with the minor job losses we've had, there's still more tech employment right now than or tech employment is still very high. Yeah. And professional and business services, a couple of like 8,000 job gains there. Also very relatively stagnant over the last 6 to 12 months. If you look at the 3-month moving average, we are actually in negative territory right now. Yeah.
So with that context, I want to get to Q&A here, but just real quick, let's bring this back, Julius, to the so what. A lot of attention is going to focus on the Federal Reserve in the next 2 weeks about how much are they going to cut interest rates. And I will say this, they will cut interest rates. There's no doubt about that. The Fed chair has signaled it very clearly in recent months that it's time to start to bring down interest rates. Now, one factor behind this success has been wage growth. We saw this number from this morning's report here. The dark blue line here is the 12-month annual rate in wage growth. You see how it's been steadily declining or moderating, and now it's around 4% year over year. So this is part of the success the Fed sees with higher interest rates and inflation cooling. One way that mechanism of lower inflation growth translates into the labor market is through wage growth, right? Wage growth moderating to historical norms, coming down is part of the success the Fed wants to see as it begins to cut rates. Now, so what's the Fed going to do? So this is our last slide. We want to turn to Q&A. I'm going to give you my take on this. It goes back to that term tweener. It's really basically a toss-up. These numbers are changing. So what you're looking at here is a screenshot of futures markets, and it's the odds of where the Fed is going to move its target range for the federal funds rate, its interest rate that it sets. Is it going to move it down by just 25 basis points, a quarter percentage point? Because 1 basis point is 1/100th of a percentage point. So is it down by a quarter percentage point? Well, there's a 59% odds of that. Is it going to go down by 50 basis points, which is a half percentage point cut? That's a bigger, larger than normal interest rate cut. The odds say here from the futures market roughly 41%. So I'm gonna stop sharing here. And I want to open it up to Q&A. Again, encourage folks to ask your questions. The point of this, Julius, I want to get your take, is the Fed's kind of stuck. Those probabilities you saw, normally they're very clear. It's very clear that the Fed's going to do one thing or the other. Here, it's a bit of a toss-up. Do you signal that we're going to preempt any potential recession by aggressively cutting rates, or do you just hold course and say, nope, we're going to see through all these data volatilities and we're going to kind of gradually reduce rates? What do you think is going to happen, Julius?
Yeah, it's a tough one. Me personally, I think the data has been sufficiently weak in recent months that I would like the Fed to cut by 50 basis points right now, to be honest. I think interest rates are very elevated and monetary policy is kind of like clearly being contractionary right now. So it's slowing down the economy. So I would like them to cut by 50 basis points, but the jobs report has been, as you said, just in between. It's been strong enough for them to just do 25 basis points. So that's my worry a little bit.
Great. So we have some questions and comments. So we have a chat and a Q&A. We have the next 10 minutes or so to address those. So first, in the Q&A, folks, please, I see some great comments in the chat. Drop your specific questions in the Q&A. That'll make it easier. And Julius, for you, I've actually got two questions from Veronica and Dean, and I think they both tie into the piece you wrote and the slides you covered just now, which is about revisions. So Veronica asked, what could have been the cause of such a large revision and the trend of continued negative revisions? And again, tied to that, I think is similar. Dean asked, do you think that this will be revised later again and go down even further like the last few months?
Yeah, so what could have caused such a large revision? So one problem the BLS, the Bureau of Labor Statistics, has been facing, I think, is that they basically, when they send out their surveys, they are adjusting they need to adjust for the creation of new businesses, so companies that are being founded each year, and also companies that are going out of business. And they are doing that with a model. It's called the birth-death model. So this is kind of wonky right now. But so a lot of economists have argued that this birth-death model that they're using has been out of whack over the last 1 or 2 years because so much macroeconomic data during the pandemic has been out of whack, right? We had the record tight labor market, we had record high inflation, we had a lot of new business formation that has been coming down now. So all these data distortions during the pandemic have probably led to this, that we have had a very high negative revision right now. Do we think whether there will be further revisions? Usually, as I said, during an economic slowdown, these revisions cluster, right? So if the economy comes out of a recession and there's a boom, then probably we have like a cluster of positive revisions later on. Now we're in a slowdown and we have a cluster of negative revisions. We're seeing that already. So there's a chance that also this month job report might be slightly revised downward later on this year. It's possible, definitely.
Thank you, Julius. Now, Grant has a question. I'll take this one about warehousing jobs. And so they ask, we see negative job growth for mid 2022 to late 2023. Is that a lag effect from COVID or are there other factors? I would say, Grant, here's how I think of it. There was a special pandemic boom in e-commerce, the whole supply chain for transportation and warehousing jobs. Those employment gains were enormous in 2020 and 2021. This was tied to consumer spending shifting towards goods, right? People are buying, furniture and doing things at their house and staying in more during that COVID period. And so there was a big boom in e-commerce jobs that really unwound as vaccines hit the US and people kind of re-entered the world and spending patterns reverted back towards more normal shares of services and travel, restaurants, and so on. So I think to answer your question, Grant, it's mostly a lag COVID effect that I would say is the explanation for the big slowdown in warehousing jobs. Okay, another question we have here is Jeff saying, what can we expect if the Fed cuts rates of 25 or 50? So here's what I would say. And I want Julius to weigh in too. I would say it's going to be a toss up. I would expect maybe there's going to be some disagreements on the Fed board that makes this decision. And on September 18th, if it comes out that the Fed cuts by just, quote unquote, just 25 basis points, a quarter percentage point, I would expect markets to kind of take that a little poorly. There would be some kind of downward declines in stocks, I would imagine. I would imagine consumer sentiment, mortgage rates, and so on would kind of hang up higher and consumer sentiment would fall, and vice versa. If the Fed makes the decision, you know what, we want to preemptively get ahead of this labor market weakening, let's cut by a half a percentage point, I would expect stocks to boom, consumer sentiment to boom. So a lot hinges on that decision over the next 2 weeks or 12 days or so. What do you think is going to happen, Julius?
Yeah, same. So if they cut by 50 basis points, that would be positive for stocks. It would create a weaker dollar. If they cut by 25, probably stronger dollar. Stock markets would fall a little bit. The decision between 25 or 50 doesn't have an immediate effect on the labor market or employment, right? It's just further down the line. We will find out whether, if they only cut by 25, whether that's enough and whether they are actually behind the curve. So the immediate effect is just on financial markets. Yeah. And the effect on labor markets and the economy at large is happening with a lag of a few months.
Nice. Well, I see some comments in the chat from Steve that I'd like to get to, which is Steve asked, he's going to a recruiter conference. He says, what's the good news to share with recruiters as employment cools? So here's how I think about it, Steve. The number of job postings for recruiters or other HR professionals is a sort of leading indicator, or at least at a minimum, a coincident indicator with job growth, right? So as employers want to hire more people, they hire more recruiters to do that hiring. What we've seen, however, as job growth has fallen over the last 2 years with higher interest rates, with the kind of rebound of all the heydays of the COVID tight labor market in the immediate post-COVID era, we've seen a huge drop off in HR job postings. So recruiters have suffered. I know a lot of HR professionals have gotten laid off. We saw a huge decline in HR job postings. The good news, Steve, to get to your question, is those HR job postings are leveling off. In other words, the decline has stabilized. I think we're really headed for a period of kind of equilibrium. That's the word that comes to mind, because I showed it with my second chart, right? Which is that supply and demand are about to meet. There's just been a big seesaw up and down with a huge surge of recruiter job postings as hiring boomed and a huge decline in recruiter job postings as hiring fell. But now we're getting to moderation. I do agree with Julius and what he said earlier. I would like to see the Fed cut by a half percentage point just as a kind of preemptive measure, a kind of security deposit to make sure that the economy is supported and we don't see further weakening. But on the whole, whether you look at growth figures like GDP or you look at layoffs, which are low, the economy is in pretty good shape. I don't expect a recession in the short term. I see this slowing in job growth as a sign that we're kind of getting closer to a soft landing. It's not guaranteed. Anything could happen in the next few months and we could see a turn for the worse. But because I don't see a huge increase in layoffs, I'm less worried. Julius, anything you want to add to that?
Yeah, let's maybe, because we've had, like, we talked a little bit about we talked a little bit about negative numbers, negative revisions, slow pace of job creation this month and all of that. let me just add that overall, this is still a pretty good labor market, right? As you said, prime age employment is still super high. The unemployment rate is still pretty low. This is still one of the better labor markets compared to the last 20 years. And so let's hope it stays that way and that the Fed will not weaken the economy any further. But overall, it's still a pretty decent labor market, even though we are seeing softening right now.
That's right. I would even summarize it more succinctly on my end and say the labor market is weakening, but it is not weak. It is weakening, but it is not weak. And so thank you all. We're at time now. I really appreciate this audience for the September 2024 edition of the Appcast Brief. Just to recap, I'm Andrew Flowers, Chief Economist at Appcast. Julius, labor economist based in London. I want to drop in the chat here a quick link to recruitonomics.com, where you're going to see further coverage of today's jobs report on that site. That's powered by Appcast. So thank you all. Please sign up for our newsletter on recruitonomics.com. Please reach out to us at appcast.io. If you have any questions about our recruiting technology, we're happy to answer them. We're happy, Julius and I, to direct you to our teams that help recruiters. So again, everyone have a great weekend. And this ends the Appcast Brief. Take care.
Take care, everybody. Thanks, Andrew. Thanks, everybody.